Welcome everyone, this is the first video in my mini series on how to become a day trader. In today's video, we're going to be going over the complete basics to day trading. So bring your pen, bring your paper, and start to take notes because you'll need it. So first part to the mini series is our options explanation. In this video, I'm going to give you a full rundown on exactly how options work and what they even mean. I know a lot of you guys are kind of confused when you come across my page and you don't even know what options are. So that is what this video is for. If you're not, if you are already familiar with options, this isn't exactly for you. You don't really need to be watching this video because it is very basic. So let's get right into it. So some categories, explanation 101, broker page setup. So I'll take you through my Robinhood Legend setup and then some examples and extra notes. So first things first, 101, just talking about what even an option contract is. What does it even mean? So an option is a contract that gives you the right, but not the obligation, to buy or sell 100 shares of a stock at a specific price before a certain expiration date. So what I mean by this is one singular contract that you buy equals 100 shares, but you do not own 100 shares. All you own and all you have right to is that option contract that you had purchased. So when you buy a contract and you're like, oh, 100 shares, you don't own the 100 shares. You don't have anything really to do with the 100 shares. You own the contract, and that is it. And no, you cannot buy half of a contract. You can't buy 50 shares instead of 100. You can't buy 150 shares versus 200. You can only buy either one contract, two contract. You can only buy a set amount of contracts. You can't just buy half of a contract, if that makes sense. But so this, in having control of options contracts, lets you make bigger gains with a smaller upfront cost. So you're not, you don't have to buy a bunch of shares to be able to make a certain amount of money. And this way, it gives you more room and more leverage. But it also comes with the risk of losing what you paid for the contract itself, either if you get stopped out or you just, let the contract expire at zero. But we have two main types of options. We have the call, which is the right to buy 100 shares at a certain price. You're saying the stock will go up. So if you buy calls, you're thinking this stock is going to rise to this certain price. If you buy puts, this gives you the right to sell 100 shares at a certain price. So you're saying the stock will go down and you will, short initially is what that is saying. And this is our page setup. So I'm going to fully explain everything and what this means here. So up here we have QQQ, which is an ETF for the NASDAQ. Current share price of QQQ is at $532.57. So down here we have our options page setup. This is going to be your strike prices. So you're saying that you think QQQ will either go up to a certain price or go down to a certain share price. And this is how much the contracts cost. Now you have to multiply each of these by 100. So you see right here, these 532 contracts cost you $3.44. You have to multiply that by 100 because you're buying 100 shares. So in reality, this contract would cost you $344 to purchase one contract. So keep that in mind. And on this page, we have our calls. On this page, we have our puts. Hopefully that makes sense. And then something also really important is our expiration date. So expiration dates of contracts mean that your contract will be expiring on a certain date. Past that date, that contract doesn't exist anymore. So right here, we have the options page set up for contracts that expire on Wednesday, June 11th, and these contracts are 1 day out contracts saying they expire tomorrow, although this was last month, but saying they expire tomorrow. Down here, we have more expiration dates. If you wanted to pick different contracts, you obviously could, but yeah. And then again, calls versus puts. We have calls on this page and puts on this page. And then we will go over all of these little categories as well. The ask, the bid, the last net change, volume, all that good stuff. But anyways, let's break it down. So again, strike price is in the middle. On the left side was our calls. On the right side is our puts. So our bid, if we're looking at a 532 strike call, so we're saying that QQQ is going to go up to 532. Our bid price is what we are asking, so what we are offering to buy the contract for. So us buyers of the contract is going to be $3.41. So we're going to be asking to purchase this contract for $3.41 on average. Now the ask price is $3.44. So that is what the sellers of the contracts are offering for these contracts. They want to sell their contracts at $3.44, which each contract costs $344. So you have to multiply it. Your last is the last traded price. So at $342, that was the last traded price of the contract. Your net change is that $1.10. The option increased in value by $1.10 today. And then the volume is 2,120. So that's the amount of contracts that were traded today. So buying one contract at $3.44 would cost you $344 total, since one contract equals 100 shares. And what that contract is an at-the-money call. Since the strike, 532 is closest to QQQ's current share price. And one other thing to note, and we'll go back, is that the price of the contracts do not really have anything to do with the current share price of QQQ. So don't get that confused, don't get that mixed up. It really has absolutely nothing to do with that current share price of Q's. Just to keep in mind. And I will get into why these contracts are priced this way and for what reason in a later video. But for now, just focus on the basics. So this is an at-the-money call, 532, because QQQ is currently trading at 532. So meaning your strike price is literally at the money, is at the current price of QQQ. So if you have a put, which is at 532 on the right side, your bid is going to be $1.72. The asking price is going to be $1.75, and the last price is going to be $1.72. The net change is $1.15. So this put went up. Since QQQ went down, this would cost $1.75 per contract. So selecting a trade, you choose your strike price and whether you want to call or put based on your market direction bias, how far you expect the move to go, and how much you're willing to pay, and what your portfolio size is. Obviously, if you have an $1,000 portfolio, you generally don't want to buy contracts that are going to cost you $3 to $4. You're going to want to buy contracts that are in the $1 to $2 range, because you don't want to be taking up that much of your portfolio in a singular trade. But the expiration date, which we kind of already went over, but you can select different expiration dates: 1 day out, 2 day out, 3 day out, week out, month out, year out. It just depends on you and what you think. Generally, if I'm day trading, especially on QQQ, I'm going to be doing what's called zero dated options. So those are contracts that expire today on the date that you're buying them. Not recommended for beginners. Obviously, they're extremely volatile since you have much less time to expiration. But I'm generally going to be buying those for my day trades. If I, predict that I'm going to be in a trade for a bit longer, maybe I'll go 1 day or 2 day, maybe 3 days out. But it just depends on you. So if you have a longer expiration date, though, that means a higher premium. So the cost price of the option is always going to be more expensive because you're buying time, essentially. And then you're going to have less decay, which means when options contracts are close to expiration, even if you're up 50%, they're still going to lose value because you're getting closer to expiration. So the more the less time you have, the more decay, and the more, how do I explain it besides decay? The less time you have on the contract, the more it will just start to lose value because you just don't have time on it anymore, if that makes sense. So longer expiration, higher cost, but you're not going to experience as much decay of the contract. So some examples, let's say you were to buy an Apple call at $100 strike and it cost you $1.50, so $150. let's say Apple goes up to 110, you profit. So this is like a general explanation. Obviously, there's some different factors that come into how much you would profit, but like this is just an example. So you profit the initial, price. So if Apple goes up to 110, you make that $10, you times it by 100, and then you would subtract it by 150 because that's the price you paid for the contract. Your profit would be $850. If Apple dropped below 110, or sorry, below 100, I don't know why that says 110. My bad. Oops. Oh. You would lose your $150 premium. Hopefully you would have risk management. You have stop set, so maybe you would stop out at $1.25. You would lose $25, or such. And then, for example, over here, let's say you buy a Tesla call at a strike price of $200 for $2, so $200 total price of the contract. So if Tesla goes up to 210 before expiration, you profit that 210 minus 200, so $10 times 1,000 times 100 equals 1,000 minus 200 of what you paid for, and then $200 profit. If Tesla drops below 200, you would lose your 200 premium, so you would lose that, the price you paid for. Again, hopefully it stops. Maybe you stop out at $1.50. I don't know. Let's say you buy one Apple put at 180 strike for $1.50, so $150 total. If Apple drops to 170 before expiration, you would profit that 180 minus 170, so $10 times 100, 1,000 minus 150, which is what you paid for. You'd profit $850. If Apple stayed above 180, you would lose your 150 premium, or you'd get stopped out. Seems easy enough, but again, these are just examples, and it is hard to profit this much on a singular contract. I'll tell you that right now. So, like I talked about earlier, time decay. So this is a Greek, and in a later video, I will go in full explanation of the Greek. So time decay is called theta. So the closer to expiration, the faster your option contract will just lose value because you don't have time on the contract. Options are wasting assets. So in the money versus out the money. So this is something I kind of touched on earlier. So in the money has real value. Stock over strike for calls. So that means your strike price is already what the stock price is above. So if we were to buy that 530 QQQ call, but QQQ is sitting at 532.50, that is in the money because your option contract is, the share price is already above the strike price of your contract. Out of the money only has time value and will lose value faster, but these are the contracts I normally trade anyways, because when you have a specific strategy, you can properly use them to your advantage, which we will get into. So out of the money, again, has that time value. So if you buy contracts that are further out but out of the money, you still have time on those, and as long as the stock goes to your bias in your direction, then you will be good on those. But yeah, why use options? So lower upfront costs, like I said, potential for higher returns, flexibility in any market direction. You could buy calls, you could buy puts, but you do have a risk of full premium loss. Obviously, I have a whole strategy on risk management to make sure I don't ever, fully lose my entire trade, but that is still always a potential risk to options. But yeah, choosing your expiration, so 0 DTE to 3 DTE, those are going to be generally for quicker trades, those day trades that I was talking about. 7 to 14 DTE, so dated, those are short-term swings, or maybe you want just more, leeway on a day trade. Normally, I'm not going to go with a 7 or 14 day out contract. If I'm taking a day trade, that's mainly going to be for swings. But yeah, and then 30 day out. So safer for learning. Again, I don't think you guys should go out and buy over 30 day expiration contracts if you're trying to do day trading. But yeah, you have less decay on those. These are really good for swing trading, maybe further swing trades, couple week swing trades. But yeah, some tools that you need to, fully start learning, you have to have a charting platform. I recommend TradingView because it's free. Brokerage, I recommend Webull because they have paper trading. So I recommend you guys all go and download Webull, download on your computer, on your phone, whatever you want to do, and go to their paper trading setup. It doesn't cost you any money. You just have to make an account. You have to have an economic calendar. You have to be aware of news going on because that affects the market, and then paper trading account to practice. So I recommend Webull fully. You can use Webull. You can use Robinhood because they have something that's called a watch list position, but it's not as good as Webull, in my opinion. Webull's paper trading. But yeah, that is going to be it for the options explanation. I hope you guys were able to learn, from me. But anyways, thank you guys so much for watching, and I will see you all later. All right, so welcome to the second half of our beginner options explanation. So in the first half, you guys learned all about exactly how options work. So I'm going to give you the real bread and butter to exactly why options contracts are priced the way they are. Previously, I had mentioned the price of options contracts don't have anything to do with the current share price of the stock that you are trading. But what makes up the price of options is something called the Greeks. So we're going to learn about those because this is the most important step to options trading. If you do not understand how the Greeks work, you are not going to be profitable. So listen up, grab your paper, grab your pencil, start taking notes. So first things first, what even are the Greeks? So how much will my option gain or lose if the stock moves? What happens over time? So with those expiration dates, what happens to those contracts? If volatility spikes or drops, how do interest rates play a role in options contracts? So I'm going to answer all of these and we're going to get straight into it. So first things first, the first Greek that we have is going to be delta. So this stands for directional sensitivity. So what it tells you is how much the option price changes when the stock changes by $1. So for call options, your delta is always going to be positive, 0 to 1. And for put options, your delta is always going to be negative, 0 to negative 1. So for an example, because that's the best way to actually understand how these even work, let's say you have a call option with a delta 0.6. So if the stock you're trading goes up by $1, that means the option contract that you currently hold will increase by 60 cents or $60. A put option with a delta negative 0.4, if the stock goes up $1, your option contract will decrease by 40 cents or $40. So why does this matter? Delta gives us a rough estimate of the probability the option will actually finish in the money. Trading is all about probability, so we want to use the Greeks to our greatest advantage to try to calculate the probability of the outcome of a trade. So next is going to be gamma, and this is delta's accelerator. So what I mean by that, it tells you how much delta changes when the stock moves by $1. So gamma is highest when the option is at the money. So that means if you have a strike price at 300 for Tesla calls, but Tesla's sitting at 300, your contracts are at the money. Gamma is lower when deep in or out of the money. So let's say Tesla's trading at 300. We buy contracts for 330 calls. That is far out of the money. Your gamma is not going to be as high. Same as if you had Tesla call contracts that were at 280. Those are going to be deep in the money. So your gamma, again, is not going to be as high. It's not going to be trying to accelerate your delta. So for an example, delta is 0.5 and gamma is 0.1. When a stock moves by $1, delta becomes 0.6. So this means your position gets more sensitive to price movements. So why does this matter? High gamma equals more explosive risk to reward. Traders watch gamma when hedging, so that hedging part is not going to be super important to us unless you are looking to hedge. But for right now, beginner's guide. So all gamma is delta's accelerator, and is in addition to. So theta is going to be our time decay. So what does it tell you? How much the value of the option loses per day, all else equal. So always negative for buyers, time decay hurts you. Positive for sellers, because they collect time decay. We are not option sellers. We buy options. That's mainly what options trading is for the standpoint that I'm teaching you all in. So theta hurts us essentially and will always hurt us, so we need to be very careful of what contracts we choose and how long we are holding these contracts so we do not get eaten up by theta. So for example, if theta is negative 0.05, your option would lose 0.05 in value per day. So if you were swing trading contracts, that's how much you would lose per day. So why does it matter? Short term, out of the money, options lose value fast as expiration approaches. So next we have Vega, which is our volatility sensitivity Greek. So what it tells you is how much your option price will change if IV, implied volatility, moves 1%. So high Vega option is sensitive to IV changes. Longer dated options will have a higher Vega. So for example, if your Vega is 0.10 and IV rises 1%, your option would gain 0.10. So why does this matter? So IV spikes before earnings or before big news events, and that can raise option prices even if the stock doesn't move. And that could also give you what's called a volatility crush, which we will get into at a later time. But that is the basics of Vega. Our last Greek is going to be rho. So this is going to be interest rate sensitivity. It is not super important. You don't really need to be watching for it too much until we get interest rate decisions, until interest rates either get lowered or raised. But what it tells us is how much the option changes if interest rates move by 1%. Call options, rho is going to be positive. Put options, rho is going to be negative. And this is more important for longer term options because we get that interest rate decision almost once a month or so. So if you're just holding options for a long period of time, this will affect you, but day-to-day day trading, I do not look at rho and I do not care about rho. So for example, if rho is at 0.03, if interest rates go up 1%, call option will increase by 0.03. So how do they all work together? Imagine you're buying a call option. Delta tells you how much you profit if the stock rises. Gamma shows you how fast that profit can accelerate. Theta reminds you that every day costs money. Vega tells you your profit may grow faster if volatility increases. And rho adds a small bonus or penalty from interest rate changes. Where to find this on your broker? So right here I have a Robinhood page set up. This was a contract that I had bought, and if you go into the contracts that you buy, you scroll down on Robinhood, it'll show you all the stats and the Greeks to your option. Obviously, you want to look at that before you buy it, but just so you know where it is, we have delta, we have gamma, we have theta, vega, rho. So this is a call option because we see that delta is positive. We have 0.5 delta and our gamma is 0.02, and theta, which is always negative, we have a negative 0.7 theta on this contract. So this one is going to lose value pretty quickly. Now, next thing is, this is how you're going to look at it. I don't know why this is so low quality, but this is how you're going to look at it when you go to pick out contracts. If you just tap on the contract you are looking at purchasing on Robinhood, you will be able to see all of the Greeks, all the statistics to it. We have the Greeks right here on this random QQQ call for April 28th, I guess. We have delta, gamma, theta, vega, rho. We got all those to show us how the contract is going to move and what is the probability of this contract, getting nice movement. We have a high theta on it as well. So this was most likely a one day out option on Qs, which obviously will be greatly affected by theta since you don't have much time on these. And then for my people who use Webull, here's how you're going to view them. This is the setup on Webull's brokerage dashboard on your computer. This is not how it's going to look on the phone. This will look how this is going to be how it will look on your phone, but not in this sort of format. Like, it'll look like this, but you won't be able to see all this. It's easier to view on your computer is what I'm kind of saying. So we have our calls, our puts, and then all of here we got theta, vega, gamma, and then you have more over here as well. You have all of them. You just have to scroll. It's a little bit different than Robinhood. Robinhood makes it a bit cleaner to see, which I do like that. And then your puts, where you can see all of them, your strike prices. So for strike price, 565, we have a Vega of 0.2, we have a gamma of 0.07, and a theta of negative 1.5, and I do not know what delta is. But if you just scroll along here, you can find that. So anyways, that is going to be it for the Greeks. Thank you guys for watching this part of it, and yeah. Thank you guys so much for watching. In today's video, I went over the complete basics on options, and then I also gave you a full explanation of how the Greeks work and how options pricings work. So if you like this video, please make sure to give me a thumbs up and make sure to subscribe to the channel so I can continue dropping more YouTube videos for you guys and for education purposes. But anyways, thank you guys so much for watching, and I will see you all later.